the webinar. Just before we get started, I think a bit of ground rules. So we will cover Hexaware Technologies this time. Hexaware is a mid-cap IT firm which was listed up till recent years back. So it was listed and it was publicly available in the markets on NSE and BSE up till November 2020. That is 2 years back from now. But around in 2020 end, the majority shareholder of Hexaware, which was Barings Private Equity, came out with a delisting offer, and they actually took the company private. And then they sold off the company again to Carlyle. How we are able to source shares of Hexaware is that a large number of people actually did not tender their shares as a part of the delisting offer. And we are actually thus able to get an investment into Hexaware because of those shares which were still lying untendered to the company during their delisting offer. Typically, we will have a 15 to 20-minute session on Hexaware. We will cover basic financials. We will cover valuations. We will cover why does it make sense to get into Hexaware, or why does it not make sense to get into Hexaware at this point of time. And possibly post that, we will reserve another 10 to 15 minutes for any Q&A which might come on this way. This is a live webinar, so therefore you can type in your questions at all points of time. So you need not wait for the Q&A to start. So at any point of time, if you have a question, you can just type it in the Q&A box and we will try and answer it as soon as possible. So I think I'll just share my screen now, and just Nikunj, if you could let me know once it's visible. Nikunj, is my screen visible now?
Yes.
All right, great. Thank you. So what we generally cover in such webinars is, how did the company came into being? How did we, stumble upon the company in the pre-IPO markets? How does the revenue financials look like? We understand a little bit on the company's product side. We get into, what makes it a worthwhile investment going forward, and how do we see the next couple of years playing out? And I think we'll be following a similar timeline or a similar journey with Hexaware as well. So before we get into Hexaware, just giving some thoughts on the IT sector. So I think the IT sector has done phenomenally well in the last couple of years. And if you look at the growth of the last couple of quarters for the major IT players like TCS, Infy, and Wipro, for the year of 2020 or 2019-2020, they had a fairly slow growth rate. So most of them would have grown on an average by 4 to 5%. Infosys had a growth rate of closer to 10%. But if you see, Wipro and TCS both would have fared somewhere around a 4%, 5% growth rate. But if you see, closer to June 21 last year is where the growth really started picking up. And for both of the last 2-3 quarters, all of the IT companies have been showing growth rates which are significantly north of 15%. In September quarter specifically, Wipro had given a 30% growth over its year-on-year sales growth. So what is this particular chart trying to hint at is, IT spends are increasing on a major level globally. So there's this research report which is published by a firm called Gartner, and which essentially took a deep dive of the entire IT spends globally. And they came to the conclusion that from 2012 to 2020, the global spending on IT had grown only by 2.5%. But over the next 3-4 years, the expectation is that it will start growing by 9 to 10% globally. And for Indian companies, this will be even more amplified because India is the outsourcing hub as far as IT companies go. So if the global IT spending is supposed to grow by 9% for the next 3-4 years, a majority portion of that would actually come in the hands of Indian IT companies, and that is where we feel that Indian IT companies are going to do phenomenally well in the next couple of years. So this is why, in terms of a sector analysis, we are fairly bullish on the IT sector because we feel that there will be natural tailwinds. Now, the IT sector is actually a fairly big sector. So what we decided to do is we decided to understand deeper into it, why suddenly after a span of 8 years, is the IT sector getting such a impetus in terms of organic demand. So what we realized is there are three things which we narrowed it down to. The first one is the entire work from home scenario, right? So a lot of companies now have accustomed or have adapted to the new reality that all of their employees will possibly not be ever coming and operating from their offices ever again, right? So a lot of companies are going fully digital, fully remote. Some are doing a hybrid structure where there is an option for you to stay at home and work, or there is an option for you to come to the office and work. But the idea being that remote work or work from home, as it has become more in common lingo, is here to stay. And this is actually taking companies into a huge automation and digitizing exercise, because to be actually be able to function in a completely work from home environment, you have to be able to provide a certain IT infrastructure to all your employees, to your procurers, to your suppliers, to your clients, to your service teams, so that they can actually function effectively. And a large portion of this will actually be driven outside the organizations through IT firms and not in-house. Coming next to the next impetus, which is moving to cloud platforms. Now, before we get into this point, I think we would want to understand what exactly does it mean when we say moving to cloud platforms. So there are two ways companies would either manage their data. Either they would keep hard data with them, maintain their own servers, have physical possession of data points, and this was very easy to manage when most of the team of a company was working in the same co-located space. So they were working out of the same office, or they were working out of the same office building, city, and or even if not even the same city, maybe in different offices, but then they were very concentrated structures. And therefore, there was a possibility wherein companies could actually have singular data centers wherein they could have stored all of their data and get their operations done. But with work from home, there is a huge need to move to cloud platforms. What cloud platforms basically means is companies take specific allocations of server space, which is not physically owned by them, and they take it on the cloud. So just for example, AWS, which is Amazon Web Services, or Microsoft Azure, are the major enterprise cloud service platforms. And these allow companies to put their entire data on the cloud so that it can be accessed by anywhere, at any point of time, by anyone. And they do this along with giving you all of the security measures which you would need. And TCS recently stated that around 20% of the large companies before the pandemic were using cloud platforms to manage their data. But in the last 2 years, more than 35 companies have actually migrated into a cloud-based system, which really shows that in just a span of 2 years, 15% of the entire gamut of companies in India have actually moved from a physical data infrastructure to a cloud data infrastructure. Now, moving to cloud requires a lot of things. It requires transition plans, it requires backup plans, it requires entire change of the way systems and processes work. And therefore, this is again one space where IT firms add a large value to manufacturing and other companies when they are trying to move their entire systems to cloud platforms. And lastly, I think the third wave which we are seeing is pure play digitization. When we say digitization, we just means that companies are going digital everywhere. So they are getting digital storefronts, digital payments, digital marketing, digital everything. The idea being whatever was being done via a physical or a paper format is slowly and steadily being moved to a digital format. So people would start doing smart contracts, which are simply signed digitally instead of making long pages of contracts which need to be couriered. People are not traveling, therefore they are digitizing the entire discussion experience. They are giving their clients an entire digitized tool wherein whatever activity was earlier done physically is now done digitally. So these are the three large buckets in which we feel there is going to be immense growth and there is going to be a natural tailwind which companies can exploit. So the first one being the digitization processes so that companies become remote friendly. The second being cloud platform transformation, and the third being digitizing whatever processes and whatever systems they have to ensure that the entire business can be conducted on an online format. And this is where we actually found a lot of synergies as far as the product portfolio for Hexaware goes. So if you see a deep dive of how Hexaware as a company has built its entire product portfolio, so they divide their entire offerings into three segments. So one is what they have named as Tensai. Tensai is basically an automation tool. So with Tensai, anything in your company which can be automated will be automated. All of these are both off-the-shelf solutions as well as customizable. So what Hexaware would generally do is say if there is a process wherein there is a procurement or there is a sales cycle or there is a working capital collection cycle which is currently being done manually, Tensai would help you automate that process as far as possible. So this goes with our first theme of digitizing everything and automating everything. And this again becomes very, very critical if you compare it to the current remote working or work from home scenario. Second is accelerate with Amaze. Amaze is their entire suite of Hexaware, which allows companies to transform from a physical warehouse to a physical data storage software solutions to a completely cloud-based offerings. So Amaze helps companies transition from storing their data, managing servers, to completely moving everything on the cloud and be able to extend those services to your clients and to your internal customers. Mobiquity is the third service under which Hexaware classifies its services. And this is basically using data insights and data-driven technology to better your decision-making processes and to service your clients even better. Mobiquity was actually purchased by Hexaware. So it was an inorganic purchase because Tensai and Amaze were built in-house, but Mobiquity was an acquisition which Hexaware had done, I think, 2 or 3 years back. And the idea was to add a data analysis and a data-driven tool set which can be clubbed with Tensai and Amaze, and then that can be offered to Hexaware's customers. So this is how the entire product portfolio of Hexaware is made out. So one is an automation platform, the other is a cloud transformation platform, and the third is a data-driven technology platform. Right? And how they combine these three offerings into various services is what is mentioned here. So they provide a digital product engineering service, cloud transformation service, digital transformation service, enterprise and next gen services, BPS, and digital IT operations. So this is different offerings combined for different industries is what they classify as a service portfolio. Coming to the next part on how Hexaware started. So I think the idea would definitely be to understand when Hexaware started and how has it, traversed the entire journey up till now. So Hexaware was actually incorporated in 1990. So it's roughly a 32, 33-year-old company. And in 1995, they actually started operations in North America and Europe. Close to 2006, they actually did their first acquisition of a US-based company called Focus Frame, which was basically a specific company specializing in automated testing of ERPs. In 2011 is when Hexaware really hit its stride. They won two very high-value contracts worth $250 million and $177 million. And they won a large IT and BPO deal. In 2013 is when Hexaware actually got an private equity investment from Barings Private Equity Asia. So Barings PE Asia invested first in Hexaware in the year 2013, and they then eventually exited Hexaware somewhere around 2020 when they actually sold their stake to Carlyle. Post this, Hexaware was actually ranked one of the top 15. It was ranked 15th in the top 20 IT software exporters from NASSCOM. They are now in more than 20 countries. And they signed another contract in 2010 of $100 million plus. In 2015, they launched new verticals which were into manufacturing and consumer centric. And in 2017 is when they reorganized their entire business, their entire product suite and offerings into the three segments which we discussed in the previous slide, which was Amaze, Mobiquity, and Tensai. In 2022, Barings actually got an approval from CCCI, Competition Commission of India, to actually sell its entire stake to Carlyle Group. And this is when they actually went ahead with the delisting as well. So in 2020, Bearings gave a delisting offer to the Hexaware investors at 475 rupees a share, and Carlyle actually bid for that, and Bearings actually liquidated their entire stake to Carlyle at a rough valuation close to $3 billion. Coming next to how does Hexaware's financials look like? In the starting with revenue for Hexaware has grown from 33,900 crores to roughly 7,200 crores in the last 5 years, which would translate to a rough 5-year CAGR of 16.5%, which is actually pretty good if you compare it with the average IT sector growth rate. So the average IT sector growth rate has been somewhere between 8 to 10% for mid cap and large cap IT sectors. So Hexaware is actually in the top quartile as far as revenue growth rate goes. It maintains a solid EBIT ratio of close to 15%. So roughly it had generated 990 crores worth of EBIT in the last FY 2021, and it translated to a bottom line of 748 crores. So this actually also shows us that it was very, very conscious in terms of debt. So Hexaware is actually a debt-free company. So they had some debt on their books up till 2019, but I think they got rid of all of their debt. They repaid everything back in 2019 or 2020. And so if you see from EBIT to PAT, there is absolutely no change. It is only the tax paid which reflects as a change. So the company actually generates a 10% net profit margin, and this is post all taxes, which is actually a phenomenally good number as far as the IT industry goes. The PAT actually has grown by a higher margin in the last year. So if you see, there is a growth of 20% in the PAT figures. This is basically because a lot of IT companies actually saved up a lot on traveling costs. So for IT companies, traveling and employee cost becomes a big chunk of their expense heads. And because of COVID, a lot of their on-site teams actually service their entire clients from the backend. This is another thing which we see going forward. IT companies maybe will not have to spend so much on travel and so much on employee costs, because they will actually be able to hire a little better, and they will be able to save up on traveling costs, because the entire system has adopted to a certain work from home concept. Which is why I think there is a change in the entire growth rate as far as, so if you compare, revenue actually grew by only 14% from 2020 to 2021, but PAT actually grew by 20%. So this actually shows that Hexaware was able to reduce its entire expense base from 2020 to 2021. So overall, covering the financials once again, Hexaware does about 7,200 crores in top line. On that, it generates 990 crores in EBITDA, so roughly 1,000 crore EBITDA. And on that, it actually is very efficient in terms of capital allocation, and therefore it does a 750 crore of PAT, which roughly translates to a 11% net profit margin on its revenue base. Coming next to understanding on how this revenue mix plays out, and this is one of the very interesting things about Hexaware. So for a lot of companies, if you see Mindtree, or if you see L&T Infotech, or even for that matter, if you see very large cap IT firms like Infi, a lot of them have a significant exposure to one particular segment, and that actually does them harm in two ways. One is that they are dependent on a down cycle on that particular industry, and they are not able to expand their service base to multiple sectors, which is what I found very interesting with Hexaware. It has a huge exposure to 3-4 different segments, and therefore it is able to hedge its risk. So even if, say, healthcare does not do well in 1 year, financial services is actually able to cover that up. Or if manufacturing is facing a downturn, healthcare or professional service or financial services is able to make up the gap in the profit or in the P&L. So if you see the rough revenue mix of Hexaware, roughly out of 7,200 crores, 33%, which would roughly be around 2,000 crores, is from financial services. The remainder large segments goes to manufacturing and healthcare, and it has about a 5% exposure to banking, a 7% exposure to travel and transportation, and 13% exposure to high-tech services and professional services. Travel and transportation, I think, had a degrowth as compared to last year, but thankfully it actually contributed a very small percentage to Hexaware's total turnover, so it did not impact the entire balance sheet by a huge margin. In terms of geographical footprint, it roughly has a 70% dependency on revenues from the Americas. European countries have a roughly 20% mix, and APAC does a 10% contribution to its entire revenue mix. So one con possibly which we see here is that it has a huge dependence on US markets for its revenue generation capacities. But what helps here is because Hexaware has actually Carlyle to count itself as a larger investor. Therefore, it will actually be able to leverage the European and the American markets to even grow their revenues faster in these geographies. Because Carlyle has a huge exposure to a lot of companies across the globe, so it will be able to collaborate and leverage on Carlyle's entire network and be able to get a better revenue mix going forward. So going a little more deep into how the verticals play out for Hexaware. So this is a broad summary of what kind of services Hexaware offers in each of them. So for financial services, it is majorly into AI, ML for capital markets. For health insurance, it does decentralized clinical trials, it does claim settlements, it does technology and SaaS platforms for healthcare firms. In manufacturing, it does a complete GTM strategy for and smart field services for services, automobile chains, after sales services. In high tech and professional services, it basically helps companies with their GTMs and it helps with their RPAs. RPA basically stands for robotics process automations. In travel and transformation, they have done contactless passenger processing. They have developed mobile apps which help in travel companies to be able to conduct their businesses. And for banking, they have developed a proprietary solution on Amaze, and they have another solution called Harvest, which is Hexaware Automation Research Virtual Innovation Services, which basically helps them to address some domain-specific challenges in the banking sector. Roughly, as discussed, financial services is the largest contributor to Hexaware's revenue. Then comes healthcare, which contributes to around 1,500 crores. Manufacturing is around 20%, contributing 1,400 crores. And high tech and professional, travel and banking overall cover, I think, close to 25% of the overall top line. Hexaware was actually acquired by Carlyle Group, and this was back in 2020. And why we feel that this is a welcome change for investors is because of three reasons. One is a private company is able to take good decisions which are better for the long term, rather than a public company which is actually to answer to investors for every quarter. And therefore, on a longer term, a private company is actually able to do much better and to take certain steps which a public company can actually not take. Second is, being a part of a portfolio company like Carlyle, it actually gets access to other portfolio companies of Carlyle, which becomes a very captive market for a company like Hexaware. And the third reason why we like this entire acquisition is Carlyle would be, being a PE firm, it will be highly exit focused, right? So they would have a plan in place already at the start of the acquisition that within 3 to 5 years, they'll be able to get to a stage where they can actually either relist the company on the bourses, or they'll be able to get a secondary exit and place it with another buyer. In all of these cases, what basically comes out is that we expect the company to be really well run. We expect it to have very dependable and predictable revenue streams for the next 3 to 5 years, and to have a very exit focused route. So we would be sure that in 3 to 5 years we will have some route to exit our investments. Coming next to, I think, just wanting to cover up why Carlyle seems like a good investment, some pros and cons. I think we've covered most of this in the earlier slides, but it has shown a significant growth rate. Number one, roughly a 16% CAGR in revenue for the last 5 years. It has a huge repeat clientele. So out of 320 clients, which it currently boasts of, 92% is from repeat business, which is an extremely good number for an IT company. Globally, it is fairly diversified. It is present in 27 countries and in 4 continents. Offering wise, we are very happy with the kind of segments which it is into. So automation, cloud transformation, and digitization happen to be 3 of our favorite segments for IT companies to foray into. And lastly, in terms of team, it has a team of more than 24,000 employees, which is present across the globe and is able to, drum up business for the company. So overall, we find the company to be very good in terms of fundamentals, good in terms of the industry which it is in. The industry seems to have good tailwinds. It has a diversified and good product offering, and it has a team which has been really which is much better in terms of attrition numbers if you compare it with the larger large cap IT firms like Infi, Capgemini, TCS, Cognizant. And I think lastly, Carlyle is the cherry on top of the entire cake. Uh, uh, what is even better is from the last reported valuation, Carlyle actually acquired Hexaware at close to $3 billion market cap, which roughly turns out to be around 23 to 24,000 crores, right? And even right now, we are actually able to get access to Hexaware at a valuation which is even lower than what Carlyle had bought the entire company from Bearings 2 years ago at. So I think that this is why we think Hexaware makes a compelling case to look at it a little more deeply. Coming next to its valuation, like we discussed, Hexaware is right now available in the pre-IPO space at a valuation of close to 635 rupees per share, which roughly values the company at a 19,000 crore market cap. This actually happens to be lower than what Carlyle had paid, like we discussed earlier. So Carlyle paid close to 23,000 crores in terms of market cap, whereas even right now we are getting at a 2-year later stage at 19,000 crores, which seems to be a very fair valuation for Hexaware. In terms of fundamental valuations, Hexaware is at a PE of 24-25. It gives a dividend yield of 2.25%, whereas if you compare it with an industry average for IT firms, it will be closer to 35-33. Fast-growing firms like Apple and Happiest Minds are at a much more steeper PE ratio. I think they are close to 60-65. On the lower end of it, companies are at a PE ratio of 19-20. Therefore, we have taken an average for the IT space as 33. So therefore, we think that there is a fair amount of 30 to 40% upside in terms of re-rating, apart from the general growth rate, which we'll in any case experience for Hexaware. So how we foresee the valuation and the journey going forward for Hexaware is, even if it is able to maintain its previous growth rates, grow its revenue and profits by 16-17% for the next 5 years, it is able to fetch a re-rating when it comes for an IPO, and it is able to enter the large cap IT firm space because it will be at a valuation of much more than 25-30,000 crores, and it is able to get a PE of 30x. I think an investor entering right now would easily be able to make a CAGR of 25 to 30% in the next 3 to 5 years. And that is the point which we wanted to drive home. Overall, Hexaware seems like a great business to us. In terms of valuation, it looks fairly logical at the current market price at which it is available. What we can also do is we can have a look at where the valuation has gone in the last couple of years. Let me see if I can present my screen and I can share the valuations as well. So, yeah. So yeah, this is how Hexaware goes. So if I shift this to max, roughly Hexaware became available close to a 500 rupee figure, and it started going up. Post that, it reached close to 710 during August 21. With the IT boom, I think it even went further up. It touched a high of 899. So it touched up till 900 rupees closer to October 30th. So in end October, early November, Hexaware was close to a 900 rupee per share valuation. Post which it actually started sliding down a little with the IT firm prices rationalizing. And I think currently it's available at a valuation of close to 615, 620. At 615, it actually comes to a price to earnings of 24 and a market cap of 18,000 crores and a price to sale of 2.56. So all of these valuations look very logical to us. A 24-25 P for a company like Hexaware seems very logical. market cap of 18,000 crores also looks fairly logical to us. And I think that is why we thought we will cover Hexaware as a part of our next webinar. Looking to take any questions. I think that is my bit on Hexaware. Nikunj, can you just start organizing the questions for me?
Right, sir. There are a lot of questions to the diminishing market cap. I mean, there's a lot of correction that has happened after the investment of Carlyle. So, if you can shed some light.
Sorry, go ahead.
Yeah. So, there's quite a lot of correction that has already happened even after the investment of Carlyle. So, if you can just reflect some points, the reasons for the same, or yeah.
Makes sense. Sure. So I think there are a couple of reasons why IT companies have not done well, or why specifically Hexaware has not done well in the last couple of months. So I think one is definitely that the entire IT space was facing a slowdown in the year 1920, and which is when companies had actually stopped investing, they had stopped taking new projects, and therefore there was a slight slowdown, and this was apparent in the entire industry as well. But I think once the pandemic was done and once company realized that digitization is the way to go, I think that really picked up. And which is why if you would have seen all of Infi TCS and the large cap IT space has also done significantly well in the last 3.5, 4 months. And therefore we see that Hexaware would follow a similar trend. Possibly it should not be at this valuation right now, and which is why we think that it is a good time for investors to enter. Last year, closer to October, it was already at a 900 per share valuation. It only came down in the last 3.5, 4 months, and possibly it also got battered a little by the recent market downfall and the recent sell off in the tech stocks.
Makes sense, right? So there's a question: which is the next best peer to Hexaware?
I think in terms of, yeah, sure. So in terms of peers, I think companies in the range of Apple and Happiest Minds would be at a similar turnover ratio. So Hexaware is close to, I think, 7,800 crores in top line. So these companies would have similar top lines as compared to Hexaware.
Right. So comparisons with peers like Coforge, Birlasoft, and Zensar would also be welcomed. Anthony Alex has posted the question.
Absolutely, I think completely agree. I think what I can do is I can possibly put up some comparison on the screen. Let me just check if I'm able to place it immediately. Yeah, yeah, I will just put up my screen. So I think a lovely question. Thank you. So if we see a basic deep dive into how IT companies are faring, roughly if I see Hexaware would lie somewhere parallel to these 3-4 companies. So, Birlasoft, Root, Saint, Intellect Design, Brightcom. These are companies which are in a similar space as Hexaware. And if we see on an average, most of these companies, Latent View being an exception, it's trading at very, very high PE of 86. But on an average, these companies are between a PE of close to 35 to 40. Right, so I think these are the target group for comparing Hexaware. In terms of the entire service base, I think it is fairly similar to Coforge as discussed. It is fairly similar to Affle India. It has overlaps with Mindtree and Emphasis as well. Right. Nikunj, can we just take the next one?
So The previous offer for shareholders was 475, but now it's around 600. So, I mean, most of the questions are being around the valuation and the pricing scheme. So, an
Sure.
overall input from your end.
Sure. So I think in terms of valuation, like we discussed on the webinar itself, I think it's valued at 24 times price to earnings. It is at a market cap of 19,500. So fundamentally, it looks logical. So 24, 25 for a IT company with a good promoter, a good diversified business offering, a good service line looks fairly decent to us. In terms of valuation, relatively to what market is demanding, like we said, Carlyle invested at around 23,000 crores. So therefore, a 19,000 crore valuation does not seem like overpaying certainly. Now, obviously, 19 or 18 is maybe subject to an investor's mindset. It is subject to the macroeconomic factors, but overall, I think a 19,000 crores is a fair amount. It's a fair valuation to start accumulating. Obviously, if it goes lower, it's always a better. It's always a great time to add on to it. I think I can see this questions on my screen. I'll just take it from here from here, Nikunj. It'll be easier. So, is there any chance to list Hexaware? So, like I said, Hexaware will not get listed in the next 2 years for sure. So, it got acquired in 2020. So, we would generally foresee a 5 to 7 year period in which a PE firm would actually hold a company, grow it, get at least a 3x, 4x, 5x multiple on its investment, and then only exit. So, possibly I would look a Hexaware listing or an exit closer to 2024, 2025. Why not Arison to opt? Arison is also a good company, but I think in terms of valuation, Hexaware is at a much more logical valuation as compared to Arison. Coming to the next one, what will be the time frame to hold the stock for getting good return in Tata Tech, Reliance, and CSK? Okay, so in general, for the unlisted space and the pre-IPO space, we recommend a timeline of close to 2 to 3 years at least, because the unlisted companies and pre-IPO companies actually give you returns in certain triggers. So either be it a acquisition trigger, or it be a listing trigger, or it be some new investor coming in. So therefore, on an average, 2 to 3 years is a good timeline. CSK, definitely we would want to hold for the long term because we see a lot of value there. Reliance Retail is something which we absolutely don't recommend. We think that it is extremely overvalued, and therefore, in our opinion, investors should stay away from Reliance Retail. Tata Tech, again, a good company, fairly expensive in its valuation. So I think even at its recent valuation, it's roughly trading at 60, 65 times its last EPS. So that seems like a little bit of a steep valuation for us to get an entry into. Maybe if it comes down to closer to a 4,000 rupee level is when it would be very, very attractive to enter into. Can this study details of the screen be shared? Yes, we will do that, Rohan. Thank you. Not audible. I think that was during the stuck up. Which listed company is the next best peer to Hexaware? I think this we covered us. Also, how do the pre-IPO purchase works? Okay, so I think Alex, the pre-IPO purchase is a very, very simple process. I can actually take you through it very, very shortly. So we have a platform called trade.altiusinvestech.com, which I was using to actually show you the graph on this. And say if you were to invest into Hexaware, all you would need to do is you would have to enter the quantity here. So if I decided to buy 100 shares of Hexaware, I could just enter my quantity here and click on place order. And this will actually take you to a order summary screen, and you can simply decide what mode of payment you want to use. Click on proceed to pay. And once you proceed to pay, it takes you to a payment gateway wherein you can simply decide what you want to pay with. You can pay via debit card, net banking, or a UPI. And once you say you make the payment, you actually get the transaction details here in your order book. Sorry, just let me get back to the sheet. Yeah, so you actually get into the order book. So if you see Hexaware Technologies has come as an order here, and it shows that the order has been placed. Once you sort of complete the payment, the shares generally get transferred to your account within a 24-hour span. And you actually are supposed to complete your KYC. So your KYC can be accessed from your My Account section, and whatever demat details you upload here is the one which we will use to transmit the shares to your account. I think I have a couple of more questions. Any visibility on tentative IPO date? Like I said, I think closer to 2024-25 is what looks logical. Previous buy offer was 475, but now it's more than 600. I think 475 was in 2020. I think there's a fair amount of growth which has happened since then. IT sector has also changed. Macroeconomic environments have improved. So I think that is the impact on the share price as well. All right, great. I think the rest are similar questions to what we have covered. And I think we have taken a fair bit of time. We generally try to complete these webinars within 45 minutes. So we are 8 minutes over time this time. For anyone, I think a lot of people have also asked whether we can get reports or the particular material which I was presenting. Certainly, you can just send out a mail to nikunj@altiusinvestech.com and we will share the presentation with you. That's not a problem. All right. I think if there are no further questions, I think thank you all for joining on a Saturday evening. Maybe next week, Saturday, or maybe the week after that, we'll be coming up with another very interesting company covering some sectoral understanding, covering some deep dive into the company, and looking forward to you guys attending that and extending your support there as well. For any specific questions, you can reach out to any of our team members, and we can get connected on a call, and we can take that discussion forward. Thank you everyone for joining in. Thank you Nikunj for organizing this. Have a great weekend. Take care. Nikunj, can we end the webinar? Do you have that option?
Right, I'll just do that.
Yeah. All right. Thank you.